All right. Good morning, everybody, or afternoon, East Coast. Didn't realize how much of a start you have for us on the East Coast. I was there in Tampa, I think, half the week this last week. And it is a little different getting in early, 6 a.m. out there. And by noon, I feel like my day's almost over in the East Coast, but it's not because my office is just getting going. Philly's in the house. Hey, Dave. All right. I was in Texas as well. I like it. I was in Scottsdale this week too. I was on a little road tour. Let us know where you're coming in from, and we'll get started in 1 minute. I got a guest joining us, Sacramento. Welcome, 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 everybody. We'll wait a couple more minutes. 90 miles south of Tampa. Good afternoon, downtown Dallas. I like it. Thanks, James. I recognize that name. I recognize a lot of names here. I like it. Hey, Steve from Idaho. I wish those were my old stomping grounds, but Idaho Falls is my old stomping grounds, which is not near as pretty as where you're from. All right, South Dakota. All right, I like it. Black Hills. I've been out there. Hello, welcome everybody. I'll wait one more minute before we get started and do an intro here. Guadalajara, but out of Napa. Wow, that's a strong. I haven't heard that before. I've heard a lot of Pittsburgh, Redondo Beach. Love it. Hey, Richard. All right. Let me get started here. Thank you all for being here on time and joining us today. Before I introduce our guest today that I get to introduce to all of you and into our community, I just wanted a couple things, a couple reminders. First, as always, we're not financial advisors, CPAs, or attorneys. Absolutely get with your team. If there's anything that you love or that you want to take away or bullet points from anything that either I'm sharing or Lamè. I always call. Said that right? Lamè.
You said it, yeah, yeah. You said
Okay,
perfect.
good.
You're good, brother.
All right. I want anything he's going to share as well. It's the same thing. We want to share our experience, what works, what maybe doesn't work. We're going to leave time at the end for some question and answers, and before we do so, I do have to do one thing, and Claudia will hate this, but I do have my Horizon Trust Company hat on. I'm going to take it off, and I've got just in representation today of my Golden
Hey.
Knights. I brought my Knights here. I know we beat up on Mammoth. I know we beat Mammoth first round, but this for those of you, I know there's not many here listening from Vegas. Probably not very many Golden Knight fans. I'm holding strong, so I apologize for those that passed before us, including the Mammoth team of the Utah expansion team. So
Hey, they've had a good
um,
run. Vegas
they
is a
had a
good
great
run.
run. They got to the playoffs, and so sorry for those who don't like to talk about sports, like my own staff that are listening. They say don't talk about sports, but here I am. So and we could talk about the NBA, but I don't need to really because my Bulls aren't there. So, congratulations to the Spurs and the Knicks. We'll see what happens. Hopefully, it goes a few more games. Okay, look. So to get going, I want to share that this is I want to share and introduce Lamè here. He's someone. I don't know if there's certain individuals that some of you meet at times at conferences or at different introductions, maybe dinners, etc. There's certain people, and I would say most people in general, I don't connect with, and that's not necessarily because I don't want to. I'm more an introvert, and believe it or not, and so for me it's very it's not normal for me to want to actually introduce myself and or talk to most people. I prefer it more like this in webinars and or big stages. And this is an individuals I met, and from the beginning I was like, I'm not exactly sure what he does, but he's always smiling, and I appreciate that because in today's world of like people that are so serious, I met him at a business conference. Just a very approachable, nice human being, and it started there. To be honest, just to share with you before I jump into who he is and what he does, but even more so, as many of you, because I know it's about half of you here. most of your names here, you know me. I am very family oriented. I don't want to talk or work with anybody who doesn't share very similar values of mine. And once again, been able to see not only the way that he and his team have worked with my team, but also the things he talks about in life and in business. He is doubling down all the time about something that's near and dear to my heart, and I know all of yours too. Your family. I think you got three kids, right? Is it three kids? Right? Probably
Four. I
working on
just had my
four.
fourth.
Four.
So
All
yeah,
right.
just
See.
had
All
my
right.
fourth.
So
She's
four.
young.
I'm
Yeah,
not totally on top of it, but four
yeah,
kids, family man, happily married, true to who he is, and doubles down on the hard work and sharing. He's a big sharer, and it's just that to me, those are probably the most important things as I introduce anybody, and especially Lamè today. But one of the reasons why I wanted him on, and have been asking about the opportunity to have him on, and for our guests to listen to him in our interview, is his success he's had. Now, I like to say I believe part of your success is because you got so many kids. And
absolutely.
I know when I started, I was 23 years old and I had four kids in 10 years. And people are like, "How do you do it?" I'm like, "Well, every time I had a kid, I made more money because I had to." And so there might be some of that with him, but I will say he's also, and we're going to leave plenty of time for question answer. So please absolutely put in the chat questions. We're going to have Claudia come on. And so, what you've done in the real estate world, in short-term rental product, and also teaching people how to avoid taxes, or defer taxes, and to find assets. And my homework says that you've done like a couple hundred properties in just a couple years. I know you've done more than that, to do that in just a couple years, let alone your whole career, is very impressive. And I think for my audience and for those listening today, that's going to be some of the things I want to talk about: is how you're doing it. Why is now the right time in the market? So without jumping into all these questions here, Lamè, thank you. Welcome to the show, and thanks for being here. Anything that I missed you want to share as well?
No, Greg, I just appreciate you, brother. Like you said, when we go to those business conferences, sometimes it's kind of how are these going to be? And really, we go for the intent to, hone our craft, right? To understand a little bit more about the market and strategies. And likewise, like me and you connected, and we're going to go golfing here soon, and I'm going to teach you how to golf.
Okay, all right.
But,
I need that.
but I just want you to know it's a mutual feeling, right? And I'm excited to kind of chop it up today. I there's a lot of things that I've done wrong, and there's a lot of things I've done right, and hopefully I can share a little bit of both. But I feel blessed and I feel lucky to be where I'm at. And to your point, it's right. Kids are they're really the secret sauce, bro. It's
Yeah.
like people always ask me, how'd you do it with that many kids? And I'm like, how could I not? It's like you got
Yeah,
them at home, you got to take care of them, And
that's
so
right.
I resonate with a lot of that. But I'm excited to share with with what little I know, brother. So.
Well, thanks for being here. Let's just jump right into it. So why don't you just kind of give us a background of, what you do, what your team and company do?
Yeah, absolutely. So, Elk Ridge today is a real estate investment tax firm, and so we aren't CPAs. What we are is we actually are strategic acquisitioneers when it comes to real estate, where we help people essentially get incredible tax benefits against their active income. So, a lot of people we work with are like physicians, doctors, W-2, high W-2 income earners. We help them attack their active income through more specifically short-term rentals, so Airbnbs. And a lot of people don't know that there's a few things in the tax code that allow you to take depreciation or tax benefit in a very significant way. And so that's kind of what my company does in a nutshell. But we have a big team. We're at about 100 plus. We're in 20 different states, have over 400 doors. 400 doors doesn't sound like a lot, but when you consider they're all individual Airbnbs, it's a lot, right? I feel like I'm running a hotel in 20 different states.
Wow.
Um, but it's been a long journey, and I'll share all of it, but we feel blessed and we're lucky. We've kind of found this niche in the real estate space to give people some incredible tax benefits, and that's what we do today. So.
So when did you start in the short-term rental space? And yeah, yeah, when did you start, and why did you start in that space? Because there's lots of different places. We've had different guests talk about different asset classes, but why short-term rental?
Really good question. So my background is professional sales. So I actually I started in the door-to-door industry. A lot of people don't know that that industry is still alive and well, right? I sold door-to-door security systems. I sold for a company called Vivint. A lot of people always, I think people have a skewed idea of the door-to-door industry, and it's all important to the context of the story of how it all started. But I firmly believe that door-to-door teaches you the essentials of business, and sales, right? Which are two most important things in life, in my opinion, right? But there's very few like opportunities where you can knock on a door. Guy comes out, he's irate, he's pissed, doesn't even know my name, but he just hates me. And in 30 minutes, I'm walking out his front door, cold Coke in hand, signed PSA, and he wants me to marry his daughter, right? Like what you learn and the skills you develop in that little time is high communication skills, high negotiation skills. You're managing emotions, you're kind of forecasting things. And so what I didn't realize is through my 7 years of my professional career of knocking doors that it would served me extremely valuable when I decided to jump into real estate. And that decision came just like any other decision, which was I was kind of tired of what I was doing in door to door. I wanted more. And at the time I was making plenty of money, making a couple six figures, but I just felt like I needed to do more. Had a life event happen with my father-in-law who passed, and me and my wife kind of looked at each other and we're like, we should really consider, trying something else. And so we looked at, what was in front of us. And it's funny because what people don't know is when I decided to jump into entrepreneurship, I started three businesses. The first one was a Pokemon card like business, like flipping Pokemon cards because there's a lot of value in them. The second was a group home agency. It was a government contracts company that I actually ended up selling 2 years ago. But then the third one was I had an Airbnb, and over the years, I felt like I had understood how to be a pretty good operator. And so I started a management company. And those are the three that I started. Time eventually started to flow of the three towards the opportunity that made the most sense, and that was the management. And so I started in the management space. Within the first 6 months of me jumping into management, specifically for Airbnbs, for short-term rentals, this is where sales kicked in. I was gritty. We signed 50 contracts within the first month. By a year, we had about 120 contracts, which was awesome. And at the time, I thought I was a good operator. And looking back now, it's funny because I just hit it at the right time. This is all right around COVID, right? And I remember thinking to myself, man, I'm so good because we started making revenue, hit our first seven figures. And I look back now and it was like a little blip. Now we realize it was like a little blip in this weird time frame of real estate, which was COVID, right?
Right.
And so there was kind of inflated. What I didn't know is there was inflated, success. Back then you could really make a bet on bricks. Like that's how high the demand was, right? And so I operated that really as the market started to progress. I started seeing people exit the market. I learned very quickly that you do not control your business if you do not control the asset. And so as people started selling off homes, contracts started dropping off left and right, and I could do nothing about it, right? And so that's when I jumped into the equity side. I was like, I want to start owning. So we opened up our acquisition arm. We found this thing called creative finance, got really good at acquiring deals. And then we essentially got into really the capital market side of things, of finding ways in which we could find capital partners, investors, people with money, and give them in exchange, equity, cash flow, and really the highest benefit, in my opinion, taxes. And once we kind of made that shift, the rest was history. And so that's kind of what led to all this. But it's funny how the journey starts. Everyone's always like, "How'd you build it in 5 years?" I'm like, "I didn't. I did it in freaking 17." Like you got to count door to door.
Right.
You got to count everything else. And so I just feel blessed that these last 5 years as we jumped into it full force, it's been a big blessing. So
Well, good. A couple things, I guess. Well, one I can relate to what you said about COVID. I remember in 2004 when I was doing real estate. I could buy anything and sell it a year or two later. It did not matter. And I thought, man, I am a genius. Like I'd buy it, I'd 3 months
Oh yeah.
later, I'd sell it. And I did that from 2004 until 2007.
Yeah.
And, at that time, I mean, 22, I was 20, I just started really 23 years old. And I
Yeah.
just thought, man, this real estate thing, it works until 2008 hit. And I was like, oh, shoot. Now I had, $20 million of debt.
Yeah.
And, I learned that, I wasn't maybe as good as I thought. Although I learned real quick, in 2008, when I restarted basically up in 2009, I went back to the fundamentals, the hard work, understanding the market, and did it all over again. That's how I knew, actually. I think I kind of knew what I did, could do
Yeah.
for a living. And I think similar here with this COVID experience you shared. Well, tell us, so what is the ideal scenario, like especially for our listeners who are IRA investors. You
Yep.
also have sent over clients to us that work with us. That's also how I knew about
Yep.
your company. How does what you do work with an individual that might have a retirement account, and maybe some of your clients that have a retirement accounts that work with us and self-directed in what you do as well? Because obviously we can talk about, and we will talk about, the tax advantages of buying real estate outside of your IRA, because that absolutely is a win. There's obviously a win by buying real estate inside of your IRA, but how do clients with IRAs work with you?
Yeah, that's a really good question. And really, it's funny because we built this entire machine, right, of understanding the market, understanding how to acquire. What people don't realize is short-term rentals, and there's a lot of noise right now in the Airbnb space of Airbnb is dead. And in reality, what that means is like it's just matured, in my opinion. You can't put a bet on bricks and make money anymore. You actually have to be a real operator. And part of that is understanding how to buy, how to essentially update it, renovate it, furnish it, and then how to execute on the management, right? On pricing strategy, SEO, etc. And so it's a holistic approach. And what I didn't realize is in building this machine, I actually built a product that could serve SDIRAs really, really well, right? And what we do very, very well is we essentially have just niched down on this asset class specifically to where, we essentially can provide returns that you can't see in today's market, right? Our STRs on average are seeing anywhere between 18 to 25% annually or more,
Wow.
right? So that's really the biggest benefit is like, and luckily because we play and mingle in the world of real estate, it qualifies as one of those asset classes or one of those investment strategies that people can essentially park money with us, right? And that's been the greatest. And again, I didn't know that that was a vehicle until after I built the machine, which was kind of a blessing in disguise, right? And so it's all those that have an IRA and you have a park in, your traditional, in traditional investments, right? Your market investments. This has been one that people have loved because additionally to the interest rates that you get from obviously or the returns that you're getting from the cash flow, there's equity involved in it, right? And there's some depreciation which we can talk about that actually you can take at a certain point in time eventually. There is a benefit to it later down the road, but for the most part, even just if you're looking at it from those two strategies and those two benefits of cash flow return and equity, it's hard to beat. It really is hard to beat when you compare it to some of the other more traditional means of how people make money in the stock market. So,
So your company does two things then. It acquires assets, Airbnb, short-term rentals, and then you also have a management company that manages those properties. And maybe I'm filling the blank here, but do you do it for other properties that you don't own as well? If someone's got a short-term rental, do you guys manage those as well?
really good question. So we are a done for you service. And we've done it that way because every piece matters, right? In terms of how it's operated, how it's purchased, how you buy it is probably more crucial than anything in today's market. You could operate a perfect property, but if you don't buy it well up front, you're going to lose a lot of money. And that's the reason why we have this all-inclusive approach where people that are coming to us are people that want all the benefits of having an asset, having an Airbnb without all of the stuff that
All the
sucks.
work.
Yeah,
That's
exactly.
me.
Exactly. And so we've just niched down on essentially that avatar. There's a lot of people that I can recommend to people too that we do all the time when people want to come to us to do it themselves, right? And there's a lot of mentors and people that I can point you to, companies, but for us specifically, we like to work with clients that essentially value their time more than their money, right? So
People are looking for something more passive. They don't want the headaches, right? That's more who you
absolutely.
work with. So you said something. Well, one, I guess two questions. One, what markets are you in? And number two, you said a pretty big rate of return. And I know nothing's obviously guaranteed, and we put that disclosure out there, but that's a really big return in today's especially tighter market. So what are you doing to get those type of returns? I mean, I have an idea of what you're doing, but can you share what market in and how are you getting larger returns
Yeah.
than others?
Yeah. So we actually took an approach that was really unorthodox when it came to an investment company, right? And investments in general. Most investment companies, to your point, and you asked the right question in the normal order at which most investments think, which is where do you buy, right? A lot of people will look at market first and then they'll look at asset, right? And they're looking in the market to find the asset. We actually do it the opposite, right? We look at the asset and how we purchase it prior to the location. The reason being is because in most any market, generally speaking, there is a demand of travel, whether it be, big or large is dependent on city, location, etc. But there's always going to be a demand for travel. What we've gotten really good at to essentially win in today's market is we've gotten really good at acquisitions on how we acquire. And without going into a whole master class, one of the strategies that we implement and how we buy at scale is we are buying a lot of deals creative finance. And what that means is just a simple example. A lot of people don't know the statistic. 45% of the homes owned in America are free and clear. What that means is there's no bank on it. What that also poses is an opportunity to approach a seller who owns a property with no underlying debt and really spark up a deal, right? Where you can create what's called the seller finance deal. And what these deals are and what they entail, just in simple terms, is I make this seller the bank instead of paying a normal bank. And the benefits of that are a few things. Speed. If I find a seller who we vibe and I can create a deal that makes sense for both of us, I can close literally in a day, right? But then the second is the terms, right? When I'm buying something from a seller directly, there's no rules, right? You can come up with whatever note that you two agree on. And so one of the things that people are always surprised at is when you look at the $250 million of assets that we currently manage, our blended average of rate of the mortgage of the underlying rate on those properties is about four and a quarter, right?
Mm.
And mind you, most of that has been purchased in the last 36 months, right? And so what we've managed to do when you buy right is we've won back that floor of cash flow just by having a low debt service because of how we acquire the property, right? And now you can see why I look at property first, market second. If I'm looking at a market like Kissimmee, for example, Florida, right? We just bought a property there. A lot of people are like, hey, this is saturated. There's a million Airbnbs. You're right, it is. However, I don't need to perform at the top 1% to beat all the competition because I can buy today at a lower rate than anybody else can. And now I only have to perform at the top, let's call it 50, 60% to be profitable, right?
Mm.
And so what we've managed to do is be able to look at the how we acquire strategically, and that's essentially created a lot of opportunity for us to win in the long game. So it's not that my properties are outperforming everybody else by a million. It's just that I am buying right strategically, but I do have incredible operations that give me at least the highest potential of that property or that asset. Doesn't need to be always the top, but at least it's the highest. And if I can create a good debt service, then it's just the margins there, right? That's how we essentially can create these margins in today's market.
So that reminds me of something that I used to share when I was doing a lot of my own real estate, which is I would say it's either your price, my terms, or your terms, my price.
Yep.
So I mean
Yep.
that's basically what he's saying is someone who's out there who's got a property for sale, let's say for $500,000, it's been on the market for a year, right? And they want a $500,000. Well, maybe it's priced a little too high. Well, if that number is really important to him, Lamè can go in and say, "Hey, look, we're going to give you 500,000. Cool. No one else is willing to give it to you, but we need you to carry back X amount of dollars, whatever that is,
Yep.
300,000,
Yep.
whatever the number is." And so then he gets his price. And the same goes like, "Hey, look, you really want to close in a week? Cool. I'll help you close
Yep.
in a week. But guess what? You're not getting 500,000. It's my price, you know?" And
100%.
so that, I mean,
Yeah.
I remember that was something, that we would talk about all the time. So, hey, by the way, lots of great questions. Keep putting them in there. We're going to go to them in like 10 minutes. So,
Yep.
we'll go back to some of these questions. So, um, well, May, share with us what maybe one of your most important lessons that you've learned, and also maybe biggest mistakes you've learned, doing this now for 10 years.
Yeah. I think one of the greatest lessons I learned is, and I'll say it this way, the greatest asset that yields the highest return, the best piece of real estate that gives the greatest return is really the real estate between your ears, right? And I say it that way because real estate is a game of essentially like just being disciplined, just understanding your numbers, understanding your markets, and not being emotional. The hard part about real estate is that it is a very emotional game. People don't think that. They don't realize that, right? It is when you're dealing in, especially in a space that I am of residential retail real estate, you're dealing a lot of times with sellers, with investors, with people that are very attached emotionally to these assets. And it's something that needs to be considered, but when you start to dabble in the game of passive, when you start to get into the game of scale, like you really have to have your head on straight and essentially be disciplined to really the metrics at which work. Your underwrite, right? Knowing what works, what you do well, and then just really honing in on that and creating a repeatable process. And so I know that sounds really general, but like it's funny how like the greatest answers to the most complex problems are often simple. It really
Yep,
is, right? And I say it, if people hear that answer, they're like, "Oh, this is something you read on TikTok." I'm like, "Well, it's the truth,
it's true.
It is like as long as you can control the asset between your ears, everything else is secondary. Everything else follows, right? And I learned that the hard way by making emotional decisions early on in my career, by getting overexcited about being in this asset that can yield 4x margin or 4x gross revenue than normal rents. And those are just like key things that people get excited about, right? But well, anybody that's been doing this long enough, your gross margin is vanity. Your net, that's sanity, right? That is really what you need to focus on. That only comes after a lot of time, experience, and discipline. And that's my greatest, really my greatest lesson I've learned in real estate. So.
That's great. That's great. So, just because I did see some of the questions that have started to come in, but so tell me the ideal scenario is, in for you as you grow and you scale your business, you're looking for individuals that are say, yes, I've got IRA funds or regular funds. I'm looking for a tax either benefit today, right, with non-IRA money, or a tax benefit today with avoiding paying taxes because I'm using my IRA. So is the ideal scenario someone that has X amount, fill in the blank of dollars, and also looking for a passive approach? Is that the ideal client that you guys work with?
Very good question. So I'd say there's actually two, right? There's two ideal avatars. The first one is, well, and I'll talk to minimums first, right? Typically, if you're 100K liquid, whether it be cash in hand or within your IRA, that's typically the minimum at which we can work with, right? Sometimes we fall under that, but there's very few, and those deals go very quick. And so typically, generally, if you're about 100 liquid, whether it's in a retirement account or whether it's in cash, those are the most ideal. The two avatars that we really look for are the people that essentially want to make above market returns very, very passively in their IRA. That's really the people that come to us and park a lot of money with us through these vehicles that we've done together, right, Greg? But then the second is more of the active side. What we serve really, really well on this side is people that have high tax liabilities, right? These are generally W-2 workers. These are generally people that have businesses. These are generally business dentists, physicians, high-tech executives, C-suite executives with high W-2s. Those are really good because those ones are people where we can effectively give them really for every dollar they put in, we can give them a dollar and a half in depreciation, which is a paper loss on their active income year one. And so right away, if somebody has, let's call it 100 grand tax liability, they give me 100 grand, I can give them 150 grand in year one. And right off the bat, you're saving 50% of that initial investment, right? And so that's really the biggest benefit that we give to the active side of what we do, which is anybody, again, that has really high tax liabilities. And so W-2s are great because they're usually people that, whether you know it or not, you have a withholding account with your employer because they're just taking it out of your paycheck. And those are the funds that essentially are like, instead of giving that to Uncle Sam, give it to Uncle Lamè, and we and we could throw it in, we can save you that money, we can create an asset for you, and that's really where we make it a no-brainer. So in those two categories is really the two avatars that I say we serve really, really well. So
And so, I mean, the answer you might have just said, but is there any trends that you're seeing right now that most investors are they're missing completely? Because I feel like I see so many real estate investors online. So, like, do you see any trends that people are missing completely in the real estate space?
yeah, I think a lot of people are missing the boat right now in real estate by way of not looking at the deal holistically, right? A lot of things you guys see on Instagram, right, are cash flow. Cash flow is king, yada yada yada. But in any good real estate deal, really, there's three big levers that need to be considered holistically. First one is your cash flow. Sure, true, that matters. But then the second is going to be your taxes, which we've talked about, and then the third is equity, right? Those are the three things that we've essentially managed to create an offer that considers also your time, right? Because the exchange of value for all three of those things and owning them entirely is you go do it yourself, right? And that
Hmm.
takes time, it takes experience, it takes a lot of losing before you win. Where we essentially have brought a lot of value is this holistic approach as a seasoned investor, because we've done this over and over again. We have an incredible team. We're data driven, but we can give you those benefits to without you really investing the most valuable asset you have, which is your time, right? And so that's essentially how we've approached this game, is doing it that way instead of just like screaming from the top, this is your cash flow, this is cash flow, because the returns I yield are holistic of all three of those benefits, right? You're getting an 18 to 25% return annually when you consider all three of those, between the cash flow, between the equity, and between the tax that's saved, right? Which is how you need to look at real estate, right? It's not a one-trick pony. Typically, if you go into real estate on a one-trick pony, you have windows of time of which they work, but outside of that, it's not sustainable, right? So
Good. Well, let's something a little different here. I mean, there's probably many clients of ours and listeners that are potential clients of ours who love the concept, love what you're talking about, want the returns, but they're like, well, hold on a second. I don't have $100,000, or maybe I
yeah.
do, but it's in other places, other pockets, so I can't put it together. If Lamè was starting over today and or giving advice to someone who is new, who wants to be in the game on a bigger level, but who can't quite be there yet, what are some steps you'd give those individuals? I mean, again, we could have some of those self-directed IRA clients here today that might say, hey, I've got, I've been around real estate for 20 years, but I had a W 2 job this whole time. I have an IRA. I got $25,000. Sounds cool, but I don't qualify. What are some first steps that you'd recommend a new person or someone who's trying to accumulate to do these deals? What would you recommend?
That's a really good question. And I'll answer it this way in reference to kind of something I said earlier, right? The greatest asset that you can own is the asset in between your ears, right? And I'm a firm believer that until you get to a liquid position of 100K in either form, really the greatest thing that you can do is really focus on self-investment to essentially supplement like that nest egg, right? And it may not be the answer most want to hear, but I genuinely, to me, it is the truth. I feel like to get to a point at which you can truly invest. And this is what people don't talk about, right? In order to truly invest, to truly become an investor, to truly become a passive, as they call it, investor, it takes liquidity. Like that's the
Yeah.
part that people don't often think or realize is it takes liquidity in either form. And until you've hit that threshold of 100 grand, my advice has always been the same, which is go invest in yourself. Go pull the levers in your life today that allow you to make more money to pump that nest egg or that number or your liquidity as fast as possible, right? And I know that's a very, again, general answer, but it's the truth. It really is. I talk to people every day, literally every day that come to us. We literally are taking 300 calls a week of this avatar, and a large majority of that is people that have the same concern. And I'm telling you, like when it comes to investing, you have to position yourself first in a way to do it, and it's all these steps. And so before you're there, it's all about the investment of the real estate between your ears. So
Good. I'm gonna have Claudia come on and join us, and as she does so, I want to also share um, the place I started when I first, if I had to start all over again, I would probably do it very similarly than I did it before, which was I was getting the knowledge, like he said, between my ears here, but I didn't have the capital. And so I was working, but I needed capital. And so I went out and found potential money partners.
yeah, yeah,
And
yeah,
so I was able to then implement, be the workhorse, find the deal, figure out the deal or the partnership, because some of my first deals I did on my own, but then as I started raising a few dollars that were not my own, I needed someone else, another company, and so I would lean on them and broker a deal. I found the
yep,
money, I found the
yep,
relationship, and I kind of brought it all together, and I got a little piece of it. So you can do that as well, and it's all around you. There's people that would love to passively get the tax write-off and or get the income and have the funds, but you don't. But if you're creating that knowledge base and excitement and energy to bring them on, that's what I did in my early 20s. That's how I
yep.
built what I built. So that would be my answer to that question too. So
Absolutely. Yep. And to your point, right? That's really an investment of your real estate between your ears, right? Is like because
yeah,
what
for
you're doing
sure.
there is you're essentially investing your time to be able to give other people value for their money, right? And you're exactly right. Other people's money in real estate is a huge game. That's what I do a lot of, right? Which is how we built our business. So absolutely spot on.
Perfect. Let's have Claudia come join us. I've seen a lot of great questions, and I could keep going on questions, but I'd rather tackle some of these ones that have come in here in our chat. So, Claudia, I'm going to welcome you on here. If not, we can do it too. But it's always nice to have a female perspective and also someone who's been watching the chat. We have not really been watching the chat. I've been enjoying my conversation here. So, Claudia, welcome, Claudia. Many of you know Claudia. Have been with us for a long time. She oversees a new business and our new relationships. And so, thank you, Claudia, for joining us today. How are you doing?
Absolutely. Happy to be here. I have some
Excellent.
questions that you might have already gone through, but they're asking again. So I just wanted to see if you guys can clarify a little bit.
Yep.
This
Sure.
one is for Lamè. What did Lamè say their ROI was?
So we're giving, and I usually think about this holistically in annual returns, right? And so our returns are yielding about 18 to 21% or more. I kind of like keeping it in that general base per year, right? The average timeline of our deals is about 8 years. And so that return holistically is essentially over the years is made in a few different ways. Cash flow, you're getting paid monthly, so our returns do yield monthly. There's an equity position that is essentially cashed out at the end of that term. And then the third is there's tax savings that are significant. Now, if you're in the IRA side, you can't really take those at least up front. There is a time in which you can take them down the road when you pull that money out, which is to be considered. But if you're obviously on the active side that me and you've talked about, Greg, like you can take those right away if you're W-2 and you have the cash, right? And so between those three, that's generally what you'll yield in our investments.
Okay.
So
A lot of our clients do have money that's not just in their IRA. Do you want to go over what the tax benefits are if you were investing personally?
yeah, those are huge, right? And effectively what it is for every dollar that you're putting in, right? And our minimum is about 100, so let's just use 100. Right away, you're getting 150 grand against your active income depreciated year one, right? And if you're in the highest tax bracket, automatically that 100 grand investment you're saving right off the bat 50% of that, about,
Well,
right?
so let's use an example. Let's say that I invest $100,000. We're not CPAs, of course. If I invest $100,000 and I make $500,000, let's say I make $300,000 W-2 income, and
Hmm.
I invest $100,000. What you're saying is I would get $150,000 credit against my $300,000. Is that correct? Credit. So
Yes.
then,
So
so
it would
you'd
be a
pay.
paper loss, not a credit, right? Because you don't want to
Oh
see
yeah,
tax,
not
because
credit.
tax
Yeah, yeah,
credits are
yeah, yeah.
different,
Sorry,
but it
sorry,
would
not
be,
credit.
yeah,
That's right.
depreciable against your income. Correct. Yep.
So that would bring your income down, correct? So then so you're essentially saving the amount you'd pay taxes on for that 150,000, right? So
Yep.
so if you're paying 40%, 30, 40% on on $150,000, you're going to save $50,000 that you would normally pay to the IRS, correct?
Yep. That's
Okay.
exactly right. And one of the key things I want to say here too is, like, for business owners, right? There's a lot of people that will expense their income, right? And at the end of it, they don't pay any taxes, but then they can't buy anything, right?
Right.
Like, they can't qualify because there's no income, right? Depreciation is one of those key tools because it's a paper loss, but when you go to underwrite, banks recognize the income. So you don't pay. So in Greg's example, you're only paying on 150 grand of taxes on a 300 grand income. But when I go to borrow, if it's depreciation and not expense, they'll recognize the full amount of my borrowing power, right? And that's
Yes.
huge. It's
Yes.
key. That's why depreciation
Yes.
is so incredible, especially when you're 1099, because then it allows
Yeah.
you to be able to play in the world of finances, of leverage, because you can go borrow, right? Because you have.
I'm a little bit laughing because my son, 24-year-old, who's crushing it and doing very well, but he's also like, Dad, why do you pay nothing in taxes, and or why don't you? I'm not paying anything in taxes. Like, well, a couple reasons. One, you're not making as much as me, but number two, I said, it's cool that you make zero money on your tax return, but you can't borrow anything, and it's why you want me to go co-sign for you is because you need income. And so I'm
That's
just laughing
exactly
because
right.
I mean, you need to have a tax return that has some income. So, anyways, go ahead, Claudio.
That's awesome. And I think you mentioned the minimum investment is the 100,000,
100
right?
grand. Yes,
Okay,
ma'am. Yep.
perfect. It looks like somebody's asking, what is your fee? I don't really know if they're talking to Lamè or if they're talking to Greg. So if you guys want to both go over any fee
Sure.
related questions.
Yeah, that's a good question. So our fees are all inclusive of the 100 grand, and of the 100 grand, we take about really the normal fees of any servicing fee. So, like, in terms of the acquisition fees, costs, like where we make our money is in the services that are rendered at market value. So in terms of us buying the property, renovating it, everything else like that, those are all kind of inclusive of that. Now, what I'll say is that 100 grand that's all it is, right? So there's no additional fees on top of that. So you're putting your 100 grand in that considers all things to essentially make sure that you get your return. So
Greg, do you want to go over how the fee structure works for
Yeah, I
IRAs?
think Richard's a client of ours, so I recognize his name, but I'll still share. So our fees are $595 in the first year, includes setup and annual, and then every year thereafter, it's based on asset value, so it's less than 1%. The average is around 50 to 60 basis points, so about a half a percent per year annual fee. That's all inclusive. I know Lamè and some of his team have worked with other trust companies because I was giving crap about it, and so that's okay. By the way, I just love that people are self-directing, but I know our biggest competitive advantage is our service and speed. So other companies are out there that might save you a couple $100. If we could save you a couple of weeks on $100,000 investment, more than pays. In fact, it way outdoes saving $100 somewhere else. So anyways, that's how our fees work.
very good
Absolutely.
question.
Somebody's saying I have $50,000 in my solo K to invest now. I know that you said 100,000 is the minimum. How would one invest if they had less than 100?
Greg said it best, other people's money, you know?
Maybe your spouse has it. Maybe you and your spouse each have 50, right? I mean that could be a solution, right?
Or if you
Yeah,
have
what?
50,000 that is personal money and then 50,000 in the that's qualified money, you can do an
Yeah,
investment that way as
yeah, we can
well.
make that work. Yeah, we've actually had people give us, different amounts in different places, 100%. So, yeah, if you have 50 cash and then 50 in investment, we can make that work.
Yeah, absolutely. Or if you have any money that's in another IRA, or in a 401k from a previous employer that you haven't transferred into Horizon Trust, you can always do a partial rollover or a partial transfer, and we can use that. Well, Lamè can put that into the investment as well. There's
Perfect.
a lot of options. Kate is asking, give us general investment estimate of a return of investment. I have the funds. That's the same thing we already went over, right? Yeah.
Yeah.
Yeah. Yeah. I think we
If
covered that.
invested from IRA, can that also be a W-2 write-off?
No, it can't be, fortunately. So those would be two different. Now it can't, and Greg, you correct me if I'm wrong because you're the expert. Because there is a depreciable value that is maintained in the home, whether they take it or not. But I believe they can take it if eventually down the road, if we still own the asset and they take their money out, right? I believe it
It
can be
can be.
applied.
Yeah, it can be. It's over the age of 59 and a half, and it just depends. I mean, there's a few more variables involved. I wouldn't get too caught up in that. I do
Yeah.
think, we've talked about this subject before about like cost seg and other different opportunities. The ideal scenario for, I think, any real estate investor is you've got two buckets of money, right? If you got money that is in your IRA and outside your IRA. So when there's these big opportunities that get tax write-offs today, you put your non-IRA money in those deals. Others that maybe, don't have this big of tax write-offs that create income or fast income or profits, you put inside your IRA. Or if you only have an IRA, don't get caught up over that. Because I think some people are like,
Yeah.
oh, well, this is better if I only have, well, you still want to make a good rate of return in your IRA. So if you get a
Yeah.
double digit return, but you don't get the tax benefits today, but you are getting a double digit return in your IRA, it's still a win. So don't beat yourself up over that. So yeah.
Absolutely. Absolutely.
Absolutely. Somebody's saying, Lamè, I'm interested in investing. Do you have a calendar that is open for scheduling a meeting?
Yes, I can get you guys my contact. The easiest way to get a hold of me is through my Instagram or LinkedIn, which I'll do, but I can try and find a link here to get to my team,
Yeah,
Greg. So
a link or in the chat, put your email or Instagram or whatever,
yeah,
and people can find it there. Also, as always, any of our guests, you can email. A lot of you are clients of ours. Email us and say, "Hey, I'd love to get his info," and we'll share it with you. So, not
cool.
a problem. But yeah, I'll make sure he puts it here in the chat. You'll see it here as we go here for the next few minutes.
Perfect.
I have two people asking what percentage of the 18% to 20% is monthly or quarter cash flow versus yearly ROI?
Really good question. It's anywhere from 6 to 8% is typically what you're making yearly. And that is dependent effectively on the individual asset itself. So it varies depending on the asset. But our goal is to essentially get you, those like to comfortably make those returns I mentioned in that price range between the three. And so the yearly cash flow will be dependent on a factor of a handful of those three things. So
Yeah. I have
Hey, by
several.
the way, there's no shame here, Michelle. I like it. Put in the chat. Talking about more income. She's an agent in Florida. She's like, if I can be a more assistant, reach out to her. All good, Michelle. I like it. No problem.
I love it.
Uh,
I love
keep
it.
on, keep
I
on
love the
going.
emojis in the chat. It's always my favorite.
Uh-huh.
um, so let's see. What about borrowing from your solo 401k? Richard is asking. Yeah. So, Greg, do you want to go over how it works?
No, go ahead, Claudia. I mean, I
Yeah.
can, but go ahead.
You can absolutely borrow from your solo 401k. You can borrow $50,000 or up to 50% of the account value or up to $50,000, whichever is less. It's a 5-year loan, personal loan, which you can use in anything, and you would be paying yourself back. You have to pay yourself back with a reasonable interest rate. So interest usually is prime plus one. Right now, prime is a little bit higher. So if you wanted to keep it at about 5%, it's up to you, but you're paying yourself back and you're growing your 401k that way. So that is not a fee that is going to Horizon Trust or anybody else. It's just basically another investment that you could do. So there's people that put a 10% and they're making 10% on their money and they're paying themselves back, and that goes back into your 401k. So a lot of people do that, and we'll help you with that process. So it's just a loan application, an AMP table, and we will go ahead and get that done within 24 to 48 hours.
Perfect.
Um,
And I see all Lamé's contact information is there. His email,
Yep.
Instagram, follow him there. You can find him on his website. So it's all there now in the chat if you're looking for it.
Okay, I think the last thing that I see here is what type of ownership do you have? Example, 500,000 property, 5 investors at 100,000 each, then those 5 own the asset.
Yeah, how do you
You're
structure it? How do you structure a
talking about
deal?
deal structure.
Yeah,
Yeah, really
give us
good
an
question.
example of a deal. Yeah, break it
Yeah,
down for
so
us.
so our deals, and again, the collective of those three things is what determines the return, which is ultimately what we're after. We are, especially on this tax side, the way that these deals are structured is they are joint ventures, and so essentially we are your operational partner, you are the capital partner, and effectively we both own the asset with those three things. The cash flow on our side, we assume all the risk, and so we make sure that the cash flow and distributions are fixed, regardless of how the property performs. And the only reason in which we can do that is because we're stabilized at a high volume of doors. So when my properties in Park City are doing great in the winter, they're compensating for my properties in Miramar Beach that are doing terrible in the winter, right? And so we kind of give people fixed distributions because of that. So you're getting your monthly payments no matter what. And then the equity and the tax benefit is really a lever that you can choose to determine what your greatest benefit is, right? So for those that are needing incredible tax benefits, we can pass almost 100% of them through to you if that's what you want. And then that just essentially changes really the scale at which what you own in equity, right? Because at the end of the day, what we're really good at is the operational side, which is an ongoing, continuous thing. And a lot of the value that we bring relative to all these other investment portfolios is that we give you fixed distributions and there's zero capital calls. And so we've been doing this now for 7 years. We have yet to ever ask for any additional money outside of your investment. And we haven't lost a house or lost an investor. And so those are all things I'm proud of. And a lot of that is because of how we've structured the deal in terms of what we know, what we can and can't do. Right. So.
But the monies are specific to a address or addresses.
Correct.
Yeah.
Correct. Yeah. So this is not a fund or a syndication. The benefit has to be passed through per a specific address for a specific individual. Hence why these are essentially structured as partnerships, as really JVs, joint ventures. And so it is one really good point of clarification. It's only one investor per property. And so you're not putting your money into a pool of money. You're essentially buying an asset. So.
So just sorry, I just want to clarify, make sure I understand. So if I have $100,000 or someone does, they would invest and be a equity owner, their IRA or themselves in an LLC that owns the asset,
Yep.
correct?
Yep.
Yeah. Okay.
Exactly it. That's exactly it. Yep. And when I say
Okay.
one investor, some people get confused. One household income that's choosing to take the benefit, right? And so, I'm speaking this from a tax perspective. You could buy the house in an LLC where you and your entire extended family all own it together. However, the benefit can only be passed to one individual. And so that's why normally it's, us and one other entity, I should clarify and say, as opposed to individual. So.
Are you comfortable with just curious, we talk about this in prior segments. If Well, I actually already know the answer if you say no to this, but I'll still share. If there's spouses and kids that have Roth IRAs and they all want to do a house together, they could do that. Oh, I don't know. I guess can they do that? I already have the solution if not, but can they do that or no?
They can. They can. Now,
Okay.
again,
Because the
it
kids might not
matters.
have $100,000, right? So it's like
Yeah.
each kid has $5,000 in their Roth and the parents have the other, 80,000.
Yeah, and they can, and again, really the logistics of the back end of where the benefit flows would be something to be thought through, right?
Yeah.
But absolutely. I mean, as long as we have one entity on file, which is an LLC, how it's structured on their end is really up to them. And, I just have to be a good fiduciary and let them know that the tax benefit can only flow to one individual. And so that's where there would need to be further discussion. But to your point, you have you have a lot of creative ways to do that. And, oh, well, now you say if it's retirement accounts, then yeah, doesn't matter.
Yeah.
Yeah, it
Yeah.
doesn't matter at all,
Yeah.
actually.
Yeah.
So yeah.
Yeah.
So
I was just thinking for those that have checkbook LLCs and that have there's a way of structuring that too, but I won't get deep into that. So great. Any other Claudia? Have anything else for us?
Yes. Somebody's asking you, please clarify 6 to 8% yearly plus 12% IRR or 12% after sale in 8 years.
Really good question. So you're making 6 to 8% of cash flow annually. And then the other two things that add to that 12% is what you're saving in real dollar values in year one. Now, if you're on the advantage, if you're on the IRA side, then that tax advantage is not something that will be considered. And so you're going to be heavily weighted. We'll essentially adjust the deal to make sure that you're receiving two of the other benefits in a bigger, you're getting more value from the other two pieces. But the other way in which you're getting that return is to your point, Claudia, that they nailed it. They're getting that at the end of the deal when we essentially liquidate.
Yeah,
So,
the equity. The equity.
yep.
Yeah.
And last question is, how long have you been in business?
So I've been doing this for about 12 years. And so in terms of the professional level at this scale, we've been doing it for about the last 10, give or take. So.
Awesome.
All right. Well, as we wrap up, just one last question. What are you most looking forward to?
I think for me, my dad always used to tell me this, and this might go in a direction I don't know if you expected, but my dad always used to tell me, he's like, son, the only reason that we ever build a business or make more money is because it increases our capacity to serve more people, right? And
Mhm.
I've really taken that into account. I think one of the more commonly, compliments I get is when anybody ever walks into our office, they're like, "You guys have a really good family culture," and it's because we really care, right? And I think that's important, especially in the world of finance and investment, right? You have to know that the people you put your money with, they care for you past the dollar. And I know that a lot of people watching this, they don't know me from Adam, and I'm just some random Polynesian, but for the most part, I like to think we've gotten where we can because people feel that, right? And we really mean that. And so that's what I'm looking forward to. Is I just look forward to helping more people, continuing to be me, doing what we can to make this world a better place. And what better way to do it than help people keep their own money for themselves and not Uncle Sam and have an asset while they do it. So that's what I look forward to. So.
Absolutely. Well, thank you. Thanks for that. Service is big on our in our hearts and what we do. So, absolutely resonates with us. I'll just end it with go Knights. Have a
Go
great one.
Knights, go.
Thanks, Greg. Thanks, Claudia.
See you guys.